me share a pro tip with you. The real reason for your struggles in trading, or in life, comes down to you. Many traders, especially beginners, tend to blame their broker, the market, or even circumstances for their trading losses. But here's the truth. The problem isn't external, it's within you. The real enemy you're dealing with is your ego. Let me walk you through a scenario to make this crystal clear. You've identified a powerful demand zone. You see a liquidity sweep, and you're confident that the market is about to turn in your favor. So you enter the trade, and you feel excited, just like the first day you went out with your girlfriend. The market starts moving up slightly, everything seems perfect. You're already imagining the profits. But then, suddenly the market begins to reverse. It starts going against you. Now, here's where the ego kicks in. Instead of accepting the possibility that the trade might not work, you decide, I can't lose this trade. So what do? You move your stop loss further and further, thinking the market will turn around any second. But the market keeps going against you. You keep adjusting the stop loss until you're deep in the red, maybe even getting a margin call. This is one of the biggest mistakes beginner traders make. They trade out of ego, refusing to accept that losing a trade is part of the game. Let me share another common trading mistake that can derail your progress if you're not careful. Imagine this. You spot a promising trading opportunity. You've done your analysis, everything checks out, and you decide to take the trade. But unfortunately, it ends in a loss. Let's say you're down $100. That's manageable, depending on your capital. The point is, you followed the process, but this trade didn't work out. A bit frustrated, you move on and find another opportunity. Feeling confident, you place your trade and set your stop loss. But again, it's a loss. Now you're down $200. Here's where the fear of pulling the trigger starts to kick in. You begin to doubt the process. After 2 losses in a row, you spot another perfect setup, but now your mind starts saying, what if I lose again? I can't afford another $100 loss. This is where many beginners freeze. Despite seeing a strong setup, you hesitate, too afraid to take the risk of another loss. But let's imagine you do push past that fear and take the third trade. This time, the market moves exactly as you expected. The price hits your target, giving you a 7.6 to 1 reward to risk ratio. That one trade nets you $760, enough to cover the previous $200 in losses, and still leave you with a $560 profit for the day. Here's what you need to understand. Trading is a marathon, not a sprint. You're not here to win every single trade. You're here to play the long game. If you respect the conditions of a high probability trade, and you stick to a solid 3 to 1 reward to risk ratio, you don't need to win every trade to be profitable. Let's dive into how a 3 to 1 reward to risk ratio can be the key to long-term profitability, even when most of your trades end in losses. Let's take the worst scenario that could happen. Here's what that looks like step by step. Imagine you have a $10,000 trading account. Now, to protect your capital, you decide to risk only 1% of your account per trade. That means on any given trade, you're risking $100. We'll break this down in terms of pips for more clarity. Suppose you're risking 10 pips per trade, and with each pip being worth $10, that equals the $100 you're risking. So if the trade goes against you and you lose those 10 pips, you lose $100. Next, your strategy is to aim for 3 times the amount you're risking. So while you're risking 10 pips, your target for each winning trade is 30 pips, which equals $300. That's the essence of the 3 to 1 reward to risk ratio. For every dollar you risk, you aim to make $3 in return. Let's assume you take 100 trades following this strategy. Now, here's where the magic happens. Even if you lose 70 out of those 100 trades, a 70% loss rate, you can still be profitable. Let me break it down for you. Out of your 100 trades, you lose 70. Since you're risking $100 on each trade, your total loss is $7,000. At this point, it might seem like you're in trouble, but let's look at the winning trades. Now let's say you win the remaining 30 trades. For each winning trade, you make 3 times what you risked, which is $300 per trade. Your total profit from these 30 winning trades is $9,000. Now, subtract your total losses from your total profits. Even though you lost 70% of your trades, you still walked away with a $2,000 profit. The key takeaway here is that trading isn't about winning every trade. It's about managing your reward to risk ratio. As long as you follow a strategy with a high reward, Compared to your risk, you can lose most of your trades and still come out a winner. The 3-to-1 reward to risk ratio works because it allows your winners to far outweigh your losses. It's about staying disciplined, accepting that losses are part of the process, and letting your winners run. Thanks for watching, traders. I hope this strategy gives you the edge you need to tackle the market with confidence. Remember, the more you practice, the better you'll get at spotting those high probability setups. If you found value in this video, don't forget to hit the like button and subscribe so you don't miss out on future strategies and tips. And if you have any questions or want to see more examples, drop a comment below. I'd love to hear from you. Until next time, stay disciplined, keep practicing, and let's conquer the market together.